So it is 9:30. I'm going to scroll through. We've got a fair amount of people here. As everybody knows, I'm a stickler for starting on time. So 9:30. Again, welcome. This is our last class. This is nonprofit accounting. And so this is the finance piece of things when it comes to running a nonprofit. And I know a lot of you are volunteers that do this. You may not have a CPA or a bookkeeper. So hopefully you get some value out of this. Or again, fiduciary oversight. You should be overseeing your CPA or your bookkeeper and be aware, don't just trust them with what they say. You should be able to check their work as well. Everyone makes mistakes. So we will do the usual. We'll do the presentation. Again, use the chat. Kathy's on here today. Myself is on here as well. And we'll be hitting up that chat. I mean, Sakina's got a lot of information, so we'll be answering questions as fast as we can. And any that we can't answer, we'll hold them for Sakina to the end. And get those answered. And again, if you logged in, stay after Sakina starts wrapping up. So don't log off because we've got a bunch of stuff to share at the end. Sakina is not going to go the full hour and a half. We know she's going to go a little faster than that. So with that, I would like to introduce Sakina Madraswala, who is our CPA at the foundation. She actually just got all of her CPA stuff wrapped up in this last, Sakina, the last year, I think, and stuff, or last year and a half. You got it done since I was there, I know. Yeah, so I'll turn it over to Sakina and let her take it from there. Again, you'll have some polls to participate in, so please do. And thank you everyone for being here.
Thank you, Avis. For those who don't know me, this is Sakina, and I've been at the foundation for about, I want to say 6 to 7 years. These last 2 years in COVID have been just a haze. I'm going to start sharing my presentation, so give me a moment. And let me know if you can hear me. I think I can hear. You guys can hear, but let me know. Okay, so the goals of this class, I would like to begin with actually nonprofit accounting, and one of the topics that we would discuss is how it is different from the for-profit accounting world. So I know a lot of you come from the for-profit accounting, and this would just discuss the small nuances, the changes in terminology, etc., of how you would read statements in a for-profit world. So the goals of this class is I would walk you through 5 essential financial reports that are and always needed to be prepared by organizations. Learning about restricted and unrestricted donations. And this question gets asked a lot. So I thought I'd do a whole segment on it. Some of you had asked during the first meeting about which 990 should I file. So I have that covered. I know I see a lot of familiar names, and there are a lot of funds under the foundation that have joined this meeting. So I would, and they had questions. So I have those covered as to what the funds under the foundation should be doing. And then somebody had asked a question on in-kind donations and where they should show up, etc. And I have that question answered. So I'm going to move ahead. So before I begin, let me tell you, I have 5 poll questions. I would appreciate it if all of those got answered. I don't see who answered what question. We just get to know in 50% answered this, or it just shows me a percentage. So I would encourage all of you to answer all the poll questions. So the first topic was the 5 essential financial reports. The first one is the statement of financial position. This is also known as the balance sheet. In the nonprofit world, we call it the statement of financial position. The second one would be statement of financial activities, which is otherwise known as the profit and loss statement. The third one is statement of functional expenses. And this is somewhat similar to cost accounting. So that's why I have it over there. The fourth would be statement of cash flows. And the fifth one is budgets. So these are the 5 reports that we would cover during this presentation. And I am going to begin with a poll question. So I'm going to give you guys a minute to answer this and mark all that apply. This is a multiple choice, so mark all that apply. I'm gonna go and grab myself a glass of water. Thanks for that.
While everybody's answering that, everybody just double check that you are on mute. I hear just a smidge of feedback.
And also, if you haven't renamed yourself with your organization name, please do so. Helps us with attendance and answering chat questions a little more realistically for your organization. And if you don't remember how to do that, top right corner, click on the 3 dots, and the bottom choice is rename.
You guys are doing great. Sakina, you probably won't hit quite 100% because it may be counting some of us from the foundation.
Yes, that's fine.
So you just let Chris know when you're ready to.
Okay, I think I'm ready. I think none of the percentages are moving, so I think everybody's got that. So I'm not sure if everybody can see, but I know I can see the statement of financial position is a 64%, which is pretty great. Statement of financial activities is 79. The statement of functional expenses is 57% of you guys prepare it. Statement of cash flows is 55, and budgets is 69. So I kind of, this is what I expected. The statement of financial activities, which is the P&L, and financial position, which is the balance sheet, are actually the 2 most prepared statements by an organization, a nonprofit, and those are the ones that everybody would like to see. I will tell you now during our presentation why the functional expenses is so important and the cash flows too. And those are the 2. So most of the, let's say most of the like QuickBooks or any other softwares that you guys use to do your bookkeeping with, actually prepare financial position as well as financial activities. You know, they're easy to prepare. They're, you know, a click of a button and most of them do it automatically. The functional expenses, the cash flows and the budgets are labor intensive. They require a bookkeeper or somebody with financial background to actually prepare those. So I'm going to stop sharing these and I'm going to tell you why all of them are important. Let's close this. Okay. And I'm going to go on to the statement of financial position. So I know this is just, I'm a millennium, I like memes. So the balance sheet is something that we would have to prepare, and most of the online software programs do prepare it for you. This is just a diagram that I like to put out there. We start off with the assets. They're green, they're lovely. You know, that's all your cash in the bank. That's all your cash equivalents. If you have stock transfers, stock donations come in, you know, your property, your plant and equipment, all your deposits, all your long-term investments. If you have any money invested in the stock market, etc., that comes under the assets portion. The second bit is the liability. So if you have any accounts payable, you've got to pay the vendors on time. You've got payroll liabilities. You've got any, you know, credit cards, etc., that you've purchased, you know, that you found that the organization uses. Any mortgages that you have, or any loans or anything of that sort, that would come under liabilities. And your net assets are your assets minus your liabilities. And I know that I have them marked in unrestricted, temporary restricted, and permanent restricted, but the new IRS law says they only have to be unrestricted, and restricted. The temporary and the permanent restricted are actually kind of grouped together under restricted under the new IRS guidelines and FASB. So I'm going to move on to the statement of financial position, and we're going to talk a little bit about assets. Assets are normally listed in the order of declining liquidity. So normally cash would come first. You would also have something like, anything that's invested in the market, that's equivalent to cash because you can sell it. There's a stock market where you can sell bonds and stocks, and you can be converted into cash easily. When you actually have something like equipment, or if you have a building that you're listing under your assets, those have a much lower liquidity ratio, and then you would kind of post it after that. So they're listed in the order of declining liquidity. Short-term assets are those that are available as cash or equivalent within 1 year. Long-term is after 1 year. So you might have CDs which expire or mature after a couple of years, and so they would come under that. So what you might want to ask when looking at asset balances are cash. Do we have enough cash to pay our bills? Is there too much cash in our non-interest bearing accounts? You might want to put them into interest bearing accounts so you can generate more cash or interest. Is our cash balance increasing or decreasing? Accounts, pledges, or payables, receivable. Are we collecting what is owed to us in a timely manner? Sometimes people pledge and donors forget that they have to make this donation for this year that they have pledged for. So that is also important. And are there any that we will not receive in a timely manner? So sometimes people forget, or they're unable to donate what they had committed. They've hit hard times, so you can write them off. You can also check if you guys have any doubtful accounts. So allowance for doubtful accounts. If you do write pledges, you don't need to have those. And what is current versus long-term portion? So you can adjust that on your balance sheet. If you're a board member, you can look, okay, do we have some significant cash, and what can be put into long-term if that's not required? I'm going to move on to the next. And we're going to talk a little bit about liabilities. These again are the same way as assets. They're listed in the order of their maturity. Short-term liabilities are those that are due within a year, and the long-term ones are multi-year loans or grants or mortgages. Sometimes you also have scholarships that might be listed there. For example, we have scholarships that are given for multi-year, for 2 or more years. So when they enroll in the first year, you can list the second year as a liability on your book, saying that, when the person sends you the second year transcripts, you have to pay this out during the second year. So, multi-year transcripts or scholarships are also listed as a liability. So liabilities have a natural credit balance. Credit to the liability account will increase it. So when you look at the balance sheet, you have normally there are 3 columns. The first one towards your left lists all the assets, liabilities, etc. in detail. Then the middle column, normally called debits, will list all the numbers, and those are normally assets. Assets are debited and liabilities are credited. So if you see an asset being credited or in the credit column, you have to ask your finance person, or why is there an asset being credited? Are we negative in our bank, or is there something that we owe, and or is it incorrect? Sometimes numbers and can be juggled around. So debit balance is normally an asset, and a credit balance is normally a liability on your balance sheet. What you might want to ask when you're looking at liabilities balances is, 1, are your payroll tax liabilities being met in a timely way? That is the number 1 question. If you have employees, if you have contractors, etc., you have to make sure that you're paying off the tax liabilities in a timely way. Accounts payable, accrued expenses, are vendors being paid on a timely, and your other bills that you're paying. You might have a cell phone service, you might have internet, you might have rent. You need to make sure you're paying those on a timely manner. Deferred revenue is, are we recognizing revenues as they're earned? So sometimes, somebody might have given us a deposit and they might have said, this is due when you are moving to the next year, when we move to the next year, but you haven't converted the liability on your books as an asset. So make sure you're recognizing revenues when they're earned, and you have to make sure there are no restricted contributions included as deferred revenue. Sometimes they are, sometimes when we move towards restricted and unrestricted, I will talk a little more in detail about this. I'm going to move on to the next slide and talk about net assets. So net assets are equivalent to the net worth of the organization. They can be liquid, compromising of short-term receivables, cash, etc. They can be fixed, furniture, equipment, inventories, land and buildings, net of long-term debt if you have any mortgages on them, etc. They can be general. So GAAP is something that most accountants follow. And first, they used to classify net assets as unrestricted, temporary restricted, and permanent restricted. Now, according to FASB's new rules for nonprofit, the temporary restricted and the permanently restricted are going to be grouped together, and they're just going to be called net assets with donor restrictions. And the unrestricted part of it is going to be called net assets without donor restrictions. If a non-profit wants to be compliant with GAAP rules and FASB rules, all their funds must be grouped within these two categories of net assets, that is with donor restrictions and without donor restrictions. And that's kind of what needs to be followed on the IRS Form 992. And this is your second poll question. Just be honest. So I'm
oh my gosh, I want to do this one.
Yeah,
I'll admit I'm the last one.
Yeah. So I had to make a special attempt because I was presenting today to actually change into some formal clothing.
But Sakina, then are you business on the top and PJs on the bottom?
No, I can show you. I'm business bottom and top put together.
Nicely done.
Yeah. I know COVID's just done this. Zoom's just done this to us, So I'm going to end the poll. And I'm glad a lot of you answered no, but it really didn't matter. I just wanted to see how many people make an attempt when they get up and, change out of their actual PJs. So I'm going to share results. And the people who answered yes, thank you for answering and being honest on this. Okay, I'm going to stop sharing. And let's see if I can close this out. Okay, I'm going to move on to the next. So we're going to move on to the statement of financial activities. This is also known as the P&L statement, profit and loss, or the net assets. Or this, this is the statement which tells you how are you doing, program-wise or organization-wise, if you're bringing in more money versus are there any deficits or any losses. So you have the income, then you have to minus out your expenses, and that's where your net income or your net income deficit comes into picture. And this meme will be self-explanatory once I go on, because your income statement is very much related to your balance sheet. So statement of financial activity. So let me talk a little bit about income. Income is normally shown by source. So and subtotaled separately as earned and contributed. So your donations are, will have one total. If they're in cash, if they're in kind, if they're, stocks and any stocks contributed, that will be all your donations. If you have any investment earnings, like your interest, your dividends, your any sort of CDs, all those will be another subtotaled earnings that have come in. So all your sources, normally they have to be separately, subtotaled, may include additional line items such as income by program, or each contributed income by source, such as government, foundations, corporate, individuals, and special events income. So most of them are, totaled separately, and expenses are the same way, by major program activity, by management, by fundraising, etc. They have to be, subtotaled separately. And showing expenses by activity or function clearly demonstrates how your organization is spending its resources towards accomplishing its mission. So I'm going to move on to the next page and show you an example of the format that I kind of like. And I know this has a lot of columns. That means you have to put in a lot of effort doing this. But some, like something like Intuit, or I think even QuickBooks does this for you. But again, you should, on the left, you see your organization name. So it says revenue earned, contributed revenue, and released from restrictions. That's another thing that's come in. So anything that was unrestricted in the past, but is now, anything which was restricted in the past, but is unrestricted now, comes into there. So that's the total unrestricted revenue. And then below would show you your expenses, program expenses, development, admin expenses. I know that this is, I've just kind of categorized them as program, development, and admin, but you could have them, each expense could have its own GL. Like for instance, we have meetings and meals, which has its own GL code. We have travel expenses, which has its own GL code. We have postage and shipping, which has its own GL code. So you could have those, and then those could be summarized under program, development, and admin expenses. So that's net unrestricted income that you earn after that. And then you've got to minus out anything that was restricted. So if you have any restricted contributions, those have to be put in there. And then you can have, on the right-hand side, you see actually all the columns that says prior year accrual, current year to date, current year to budget. So a lot of people put in their budgets and they compare that to how we're doing year to date. So percentage budget to the dates that are actually their year-end forecast. So a lot of people change, saying that their budget, and I'm gonna try and enlarge just that. Let me see. I know. Oops, I went back to the poll question. So I unfortunately can't enlarge that, but I will send you my presentation and you could definitely take a look at that. Year-end forecast. So, you might change your budget and you might decide, let's do a year-end forecast that's different from your budget. And then you might do a budget to year-end variance. So how different is your actuals to the budget? And you might do a variance, like we're 10% off, or we're like 20% under budget, that sort of a thing. And I actually can send you more of this a little later. Like when I send out my presentation, there are so many formats that you can follow. This is just something that I pulled up because I thought this was easy to read and it kind of summarized everything well. But there are so many other formats that, Google is a great place to look at them, but I can send you more details if needed on, the different formats that you could follow. And I'm gonna put in a poll question right now. And this talks about your organization's net income last year. So this is if you were to take 2021, if you've already closed the books. I just want to see where everybody's at, so we kind of know. And it's okay to put that 0% because a lot of people are in deficit. They may have spent out more helping people in COVID times, or so if you've spent out more than you've actually earned or received, that's fine too.
Sakina, while people are answering the poll, you have a question. Can you define restricted contributions versus released to unrestricted?
And I have that slide.
Okay, great. We'll hold it.
Yes, hold that question.
Thanks, Teresa.
Yeah, that I have a slide which I will stop on, and it's fun to look at the slide. I'm going to be honest. I pulled out some of this from our we do CE credits for continuing education credits for CPA. And I pulled these out from, and I pulled out that specific slide from that because I loved it. I loved
you can tell you guys, Sakina is a CPA through and through. She loves it.
Yeah. And I know I see a lot of familiar faces. I did something similar for Elevation a couple of years back. I want to say 2018. I did that when I was pregnant with my daughter. I remember having a pregnant belly and going up on stage and doing that. So I think I did a very similar presentation to this in 2018. And I know a lot of our fund members attended those. So this is something similar, but I hope, it's always good to refresh memory and learn. And I've added the new changes that FASB and GAAP, have put in. The IRS guidelines have changed after that. So I put in new stuff. So I'm going to end the poll. I think we've got almost everybody answering this. I'm going to share the results. So let's take a look. We've had about 7% more organizations who've been at the $0 or at least are, I would say, having made that much, that's fine. You've spent more than you've earned. That's okay. That's what nonprofits do in times of need. We've had about 29%, 16 organizations who received a net income of $10,000 or less. We've had 7 organizations receive 10,000 to 25. We've had about 13%, which is 7 organizations, 25 to 50. And then there are a few who received more than 50,000, and that's great. So I'm going to stop sharing and I'm going to go back to closing this. Close. Okay. Going to move on to statement of functional expenses. And let's see if this is. Okay. So I know, so the next 3, the statement of functional expenses, the cash flow statement, as well as the budget, these are labor intensive. And that's why I've got more written and more, So functional expense is a method of grouping expenses according to their purpose. For example, program and supporting services. And I also have an example towards the end. So this will make more sense when I go to that example. Natural expense classification is based on the type of expense, such as employee benefits, rent, supplies. If you have, if you're running a program, there could be program specific like travel, meetings and meals, etc. So that's natural expense classification. Functional expense is based on the function. So it could be program, it could be supporting, it could be management, it could be fundraising. If a nonprofit is a 501c3 or a 501c4, presenting a functional expense classification is also necessary for IRS 990 form purposes. So these could be actually in the 990 form, or there should be one in the notes at least. So that's the new rule, that you have to have a statement of functional expenses. And I'll tell you why this is so important. There can be different users. Board of directors can look at this and see where are we making money and where we are losing money. There are regulatory agencies that look at this. There are lenders. If you go to the banks for a loan, etc., they could be looking at this. And there are donors who look to see how much is an organization spending for its fundraising program, whereas how much is it spending on management expenses. So this kind of shows the donors where the money is actually going. And I'm going to give you the 2 ways that you can actually do this. There's a direct allocation method, and there is a indirect allocation method. So it is a combination of identifying expenses by function and natural classification using one of the following methods. Direct method uses each expense to a functional category based on direct usage. And this just means, example, a nonprofit receives a $1,000 phone bill. So you have $1,000 in your phone bill. There are 4 members in the fundraising team. There are 4 members in who are employees of a nonprofit's daycare program. And there is an executive director and an assistant director who also have a cell phone. So you have 10 people total, you have $1,000. There are 4 people who use it in the fundraising team. There are 4 people who use it in the daycare program. And there are 2 people who use it in management. So you would make it 400, program would be 400 and management would be 200. This is like a simple way, you have 10 people, you have $1,000 involved, but each one is at 100 and you do this. An indirect method of allocation is maybe beneficial when expenses for which direct could be too time consuming. So if you're not able to find a way to do this directly, you would move towards doing this in an indirect way of allocating the expenses. So you would actually use financial as well as non-financial information to determine if an objective basis to which to categorize the expense. And I'll give you an example. A nonprofit is leasing a building and you pay rent for it. How do you find out whether the rent is actually fundraising, program, or management expense? So think about the square footage of the building that you're leasing or you're renting out, and think about, I use 2 rooms for fundraising. Most of the people who come in are people who work with fundraising. They're volunteers. They come in and they use these 2 rooms. The 4 rooms being used for like a nonprofit daycare program. I'm just giving this as an example. So you run a daycare program. The 4 rooms are going to be used by the daycare program. So you would allocate if you have 10 rooms, out of which 2 are used for this, 4 or 5 are used. So you just kind of base it based on the number of rooms or the square footage that you are using to that specific program. Like fundraising, you would allocate that much percentage, program expense that much percentage, and management would be that much percent. If you have somebody who's sitting like a director in one of the rooms, then you would have that allocated too. I'm going to move on to giving you an example. So in the example, so the statement of function and expense is kind of described like a matrix, since it reports expenses by their function and by the nature or type of expense. So if you look at the blue column, it says that's the nature of expense. There's salaries, there's rent and utilities, there's printing and supplies, and there's depreciation. And on the top are the programs that you're running. So program 1, program 2, management and general, and fundraising. Now, this could literally be cost accounting too. A lot of organizations, for instance, they get the $10,000. The donor has said, I need you to use $2,000 for this. I'm sending you $2,000 for this, and I'm sending you $4,000 for this, and I'm sending you another $2,000 for this. What they do is they take the $10,000 and they put the entire amount in their checking account, and they don't follow the donor instructions. This is just a way, if you use an Excel sheet, Excel works just fine for this. You can just, have these programs, just as you were doing salaries, benefits, expenses, you can also do donations in this way, and this would be called cost accounting. So you would have program 1, program 2, management and fundraising, and you would have the nature of the expense, like if you're using salaries, what percentage is going in program 1 versus program 2 versus general management and fundraising. I'm going to move to the next slide because I want to show you a lot of organizations and donors actually want to pay only for program service expenses. And it may work in the short term if you're volunteer driven, if you don't have salaries and benefits, if you don't have a management staff, everybody's volunteer, that's great. But you will end up having management expenses. Once you are in a program, I'm going to go back to my previous slide. Once you are in a program, and I know a lot of donors just want to give towards their program expenses and nothing towards management and general expenses. And that's one of the reasons why we have this grant that we want to give out to organizations to grow, is because there always is a management and general expense. No program goes, unless you're all volunteer driven, there is no way that your organization will not have management and those kind of expenses. So a growing organization will require the underlying business systems, personnel to sufficiently grow with it. So I would say reach out to your donor base whenever you meet a donor, or you're talking to somebody generally. Let them know that, you know, not only do we have expenses for the program, we also have operational expenses. And I just want to throw it out there. I know this is not what I do. This is something that's done by Lois, who is the donor services at the foundation. Whenever we have somebody who comes by, a donor who wants to leave us a legacy gift, etc., we always ask them to consider even the foundation. And there is no harm in being frank and talking to a donor, letting them know that, you know, would it be okay if you left a 5%, if you're giving like 100% towards a program, would it be okay to take out the 5%, you know, to the foundation for its operations? It's a great way to approach a donor. Donors normally like to be, you know, the organizations to be honest about it. So this is a great way to approach a donor and let them know that there will always be not only program, but even other expenses management related. And I'm going to move on to the next one, which is statement of cash flows. And the cash flow statement reports the cash generated and used during the time interval specified. So the reason why I have the cash flow, and you would think that, you know, isn't the profit and loss statement the same thing as a cash flow statement, because the profit and loss also shows the amount of money generated. What I'd like to keep it, what I would like to bear in mind is that cash flow is different from profit and loss only because there are pledges involved. There are a lot of things that don't become cash at the end of the year. It could be CDs, which you have or which are invested and mature after a couple of years. It could be a lot of things you might have on your assets. You might have a building, a plant or equipment. You might have office furniture, things like that, that generally don't show up as cash. So that's why a statement of cash flow is required. So you know how much of cash you're actually generating to pay everybody on time. I'm going to move on to the next one. And this shows the statement of cash flows. So there are normally 3 sections. The first one is operating. This is normally reported on your income statement from the accrual basis of accounting to cash. So most nonprofits, in fact, most of nonprofits that I know of, and most foundations and organizations actually use the accrual basis of accounting rather than cash basis of accounting. Accrual basis of accounting is where somebody who is, you know, like a pledge that you would receive next year is actually recorded on your books for this year if you do pledges. So we record that saying this person has promised us the 5,000 this year, and we're recognizing the 5,000 as a donation or as an income for this year, but whereas the money will only come in next year. So that's where operating activities come into play. That's why income statement is always in the form of accrual basis of accounting, where even what's promised to us is recorded, but generally it's not coming in cash this year. The second one is investing activities, where reports the purchase and sale of long-term investments and property, plant, equipment. So this is something, like I said, you know, if you have a building that's going on sale and you have it on sale, you have it listed as an asset, but the money hasn't come in yet. Financing is where issuance and repurchase of companies' own bonds and stocks. This is generally not, you know, something that or nonprofits do. We don't issue our own stock and bonds, but it's in there covered under the statement of cash flows in case it's a company or a, you know, giving out dividends, etc. And then the fourth portion is the supplemental information. That's the exchange of significant items that do not involve cash, and reports the income taxes paid or the interest paid for that item. So I'm going to move on to the next part.
Before you do, just because I know I had just had a question come in that may be a little over my head, so we can answer it. Is it required that accrual basis accounting be used?
No, it is not. I just know that a lot of people, the foundation does accrual basis. So I know people might say accrual basis. You could use accrual basis and not record pledges. So the foundation does not record pledges just because the IRS guidelines said that foundations, after they reach a certain amount, should not record. It just makes the your profit and loss statement go to up and down. So you could still use accrual basis of accounting, but not record pledges. Accrual basis of accounting is actually the preferred basis of accounting by by CPAs, but that is not the only way. A lot of people do cash basis of accounting. Accrual basis is generally more covered because you can see what's supposed to come in for the next year, and it takes that into account. But by doing accrual basis, you do not have to necessarily record pledges. That's another thing I wanted to throw out. And that's a good question, actually. So you don't have to record pledges. And I'm not looking through each and everybody's chat, but I can definitely get back to you on some of the questions asked in the chat and concerns. But accrual is the preferred method for accounting. I know we follow it. I know a lot of nonprofits follow it. And so you can do cash basis. There's nothing against the cash basis of accounting. It just does not show you the complete picture. And by doing accrual doesn't mean you have to record the pledges. You can not record pledges and still follow the accrual basis of accounting for your books. So I hope that answers some of the questions out there. But the next one is a poll question. So I want to make sure. And there's no right or wrong. It's just something that I'm throwing out there to see how much everybody knows. So the question actually says, so take a guess where your organization in-kind donations are described if they aren't reported on your statement of activity statement. So if you are doing a statement of activities statement and it's put in there already, if you're doing your in-kind donations and you're not putting it in your statement of activities, where would it show up? Okay, I think a lot of people are changing your answer. So I know it's a tricky question, and that's why I threw it out there after this. So take a guess where your organization's in-kind donations are described if they aren't reported on your statement of activity statement. So if it is reported on your activities of statement, I'll give you a hint, it's operating activities. If it is reported, so if it's not reported, where else would they show up? Okay, I'm going to end the poll. Does it let me end the poll? Okay. So 52% said operating activities. Now, if they were reported on your statement of activity statement, that is, if they were reported on your P&L, then that's right. They would show up as operating activities. And most of your in-kind donations should show up on your operating activities if you're doing fundraisers, things like that, etc. But if it is not reported there, then where should it be? What kind of an activity it is? It is a supplemental information. So that's towards, they're not investing, they're not financing activities. It would either show up in operating activities, and if you put it there, your in-kind donations, then great. But if you don't put it there, where do you need to put it? You need to put it in your supplemental information saying this is the number, this is the amount of in-kind donations that we received for this fundraiser or this event that we held, etc. So I'm going to stop sharing that.
Sakina, if you're going to hit this one later on, the question as far as if you're a fund at the foundation, if not, if you could answer
Yes.
this one now. If you're a fund at the foundation,
Yes.
how should you be reporting your in-kinds?
You should let us know about what in-kind activities you have, and I will walk you through. So we have, this is a tough question to answer because we have 6 or 7 different types of funds under the foundation. And depending on which kind of fund category you fall under, I will tell you what you need to do. So this is a question for later.
Got it. Thank you.
Okay, let me see if I can move on to the next. Okay. What can the statement of cash flow tell us? So because the income statement is prepared under the accrual basis of accounting, the revenues reported may not have been collected, and the expenses reported on the income statement may not have been paid. So the cash flow statement integrates all that information, and you have to actually compare it to the operating activities, you know, of the net income that your nonprofit is generating. So there are 2 methods to do this. This is pretty simple. The direct method is you have the traditional cash flow, you have the beginning cash, so you hold this much cash at the beginning of the year. You add the cash inflow that's come in, all the donations, all the collections, etc. And you would only add the cash donations. You would not put in any stock transfers, things like that. You would only add your cash. You would minus out any cash outflow, any expenses, taxes paid, anything that you've paid out using money. And then you would minus any financing activities like investment proceeds, you know, if you've paid any capital expenses, etc., things like that. And that would equal to your ending cash flow. It's pretty simple. You take your beginning, you add what's come in, you minus what's gone out, and then you have your ending cash flow. And the second one is the indirect method. And this is where you would use your company's balance sheet to find out the information needed. So you would begin with change in net assets. That means what's your profit and loss amount that's come in. And again, if this is accrual, remember it's got all the stuff that we haven't paid. It's got all the stuff that we've not gotten yet from donation. So it's got the net assets, change in net assets. You would minus out any non-cash expenses. You would add any non-cash expenses because you haven't paid those out yet. You would minus any gains and losses because those are financing activities. Again, you would adjust them depending on your current assets and liabilities, and you would have the ending cash. This is a very cumbersome way to do it, and normally most of the nonprofits do not follow this way. You don't have to go this route. The first one is what most of them do. This is just a way like how you would get the final answer and then pack out everything to get your cash flows. So this is like the behind method, which not everybody follows, but I just wanted to throw out there that there is a way if you're doing accrual system that you can follow this. I have an example on the next page. I know that this is a little difficult to read. I'm not going to go through each one of these categories, but once I send the presentation out, I definitely want you guys to go and look at the slide and see what exactly is there. And I was going to ask you another question, like, do you think this is the direct way or the indirect method? But since this is so small, I can understand if you can't read it. So I'm going to move on to the next slide. I definitely want you to see this when you have time after the presentation, when I send you the slides. And then I'm going to move on to budgets. So it is a guide that can help a nonprofit plan its future as well as its current financial health. Creating the annual budget is initially the staff's responsibility. And the reason why I say this is, yes, it could be an ED, it could be a finance person who's doing this. But it is it is the person who's handling the day in money and the day out money. portion, the staff's responsibility to do this. The board members, usually those who sit on the finance committee or the executive committee, often review this and pass it on to the board. The board approves the budget, and then it goes to the full board meeting and is published there and is approved. And this kind of serves as a guideline. You know, it's an approved budget, which serves as a guide for the months ahead. And this is something that somebody once told me when we were going above the budget, and you know, there was a lot of anxiety on my part. They said it's just a number, and sometimes we need to remember that it is just a number. It can go up if it can be explained, then that's fine. If it's not explained, then that is a problem. Normally it should begin at least 3 months before your fiscal ends. So if you are a fiscal organization, your books end on 12/31. I would say start this in the month of August and September, and you know, by the year end, normally it is approved, gone to finance, approved, and you know, by Jan you would have to follow the budget. I'm going to move on to the next slide. I'm not going to go into budgets because I know most of you guys know how it is that you need to prepare a budget, what you need to do, you know, the ins and outs, and budgets can vary depending on what kind of a nonprofit you are. So why do nonprofits need fund accounting? And this is fun. This is where I will answer all your questions on restricted and unrestricted. Fund accounting enables nonprofits to allocate their money into different groups of funds in order to keep them organized and only spend funds on what they're designated for. Nonprofits will commonly separate their money into groups such as restricted and unrestricted funds. And I'm going to move on to the next slide, which talks about the fund accounting for nonprofits. And I know this is really small and the words may be hazy, but once you get this, you will understand it better, and I will walk you through it. This is where I will take my time. So if you look on the left-hand side, the one with, I want to say, the brown tab or the gray tab almost, those are contributions with donor restrictions. And they are ones normally for perpetuity. So there is a donor, I'm going to talk with an example in this case. There is a donor who gives in, you know, for instance, 100,000. And they say this 100,000 has to last in perpetuity. It has to be invested in the market, and there is 5% of that investment that you can take when it's doing and earning. Only the year that it has earned money, not the year that the market's gone down, but the year that it has earned money, can you take money out from this fund? And they've restricted it to 5%. So when that money comes in, it'll go into the first tab that's on the left-hand side with a brown-gray tab, okay? And that's where the money comes in. So if you look at the next one, I want to say with the green tab, that's the investment income. So if that year the markets do well and that 100,000 earns, say, 10% interest, 5% of that interest, as the donor had specified, can be used for ABZ program. So that money, 5% of that money trickles down into the second tab on your left-hand side. Now, if you can see, there's another tab that's sending money from the second tab on your left that's also sending money to that tab. And that is contributions with donor restrictions, which are subjected to either purpose or time. And I explained that. So a donor may say, I'm giving you, another donor, not the same donor, but another donor says, I'm giving you this $10,000, but I want you to spend $2,000 every year for the next 5 years on this XYZ program. So one, that's restricted to the XYZ program, and the two, the entire 10,000 is not to be spent in that 1 year, but to be spent in the next 5 years. So you've got to break it up for 2,000. So that money comes into the second tab also. One tab is, the first tab is the one which has to live in perpetuality. So we can't even touch the money, the 100,000 that's coming, but the 5,000 which came in for its investment in the market comes to the second tab. And then, you know, there's a second donor which gave the 10,000. going into that tub too. So what comes out from that tub is actually the big, it's the last one is the third big tub, which shows the 2,000 which the donor gave for that specific year can be spent. And then the 5,000, which was investment, can kind of flow down into that. And if you see, there are ice cubes there. The ice cubes are basically time restricted. So the ice cubes, once they melt in the second, third, fourth, and fifth year, only then they can be spent. So ice cubes kind of show the time restrictions, and also purpose restricted. So if you might have a capital campaign project coming on in the next year, you can't really spend the money this year, you've got to be spending it for the next year. So this kind of shows that. Then there are two tabs on the right. One is the green tab, which is without any donor restrictions. So contributions coming in without any donor, you say that's money just coming in. People just donate to the nonprofit, to the funds, etc. And then the second tab is earned revenue. So if you have your own endowments in the market invested, or in a foundation like ours invested, you also earn a revenue on that, or your 5% available to spend, and that's coming back to you again unrestricted. So all this water comes in. You would have basically your large tub is where now you would have to spend your money in, which is unrestricted, and you could spend that. So I hope this has cleared some of the doubts. So anything which is temporary restricted is basically time and purpose restricted. And anything which is permanently restricted is the endowment or the corpus or the principal that the donor gave initially, the 100,000, that can't be spent ever, but their investment or the money that it earns can be spent up to 5% every year. So when I say with donor restriction, it's got some kind of restriction attached to it, either time, either purpose, or either investment. It can only spend the 5%. And without donor restriction is the large tub, where people just give without any donor restrictions, or it's money that has come in with earned revenue without any, anything holding it back, and you could spend the entire amount. I'm going to move on. Are there any questions on this? Because this is a big slide, and I know a lot of people had any, so I'm not seeing any actually. Okay.
You got one. You said that temporary restricted funds like these shown can be included with unrestricted. Yes?
No. So restricted and permanently restricted should be together. Anything which is unrestricted, let's just imagine this way. Unrestricted is totally unrestricted. Anything which has a restriction has to either come under temporary restricted or permanent restricted. Now, if you remember my cash flows, and I know I'm just talking a lot, but if you remember my cash flows, anything which every year you've got to check, is there something that's restricted? Now, can it become unrestricted? Because the time, either A, the time has passed. If it was time restricted, the time has passed. Or B, is it that that we're doing this XYZ project now, and the donor had given it for XYZ. So can something come out from my restricted, which is temporary restricted, which is due to time or purpose, and can it move into unrestricted? So restricted is anything with restrictions, whether it's temporary or permanent, and unrestricted is just unrestricted for the year. We can go ahead and spend it. It's all, now it can all be spent. So I hope that answers the question, Alice. I am going to move on to the next slide. I know I've taken like 58 minutes, and I'm going to take another 15 minutes to answer some of your questions, because these were the questions that were asked during the first initial meeting. And this was a question on 990 filing. So let's ask, what's 990N versus 990EZ? What's the difference? And there are only two things, in my opinion, that are certain, said Benjamin Franklin. One is death and one is taxes. So most of us do everything that we can to postpone and avoid both, but postponing or avoiding your taxes won't make them go away. You've got to file your taxes, and nonprofits, while actually you guys don't pay taxes, you still have to complete these tax forms. So the 990N, which is filed by an organization with gross receipts less than 50,000, is actually an e-postcard. It is sort of done, it's an electronic form, and it can be done online, and that nonprofits that are eligible must form theirs electronically. Form 990 Easy is anyone who has gross receipts between 50,000 and 200,000. So somebody who has less than 200,000 but greater than 50,000 in their net profits can do this. And remember, this is not net, this is gross receipts. So if you've received donations for more than 50,000, you've got to file this. If you would like to, you can also file the form 990, the entire form. You don't have to do the easy form, but I will make sure, but obviously the 990 easy form is the easier form, and people do attempt doing that. So Form 990 is the next one. So if you've got gross receipts for more than 200,000. So Form 990 is the IRS form that's required for larger tax exempt organizations with annual gross receipts of over 200,000 or total assets over 500,000. So if you have assets which are greater than 500,000, even though you don't make that much of you don't get that much of gross receipts, but your asset base is above 500,000, you still have to file the Form 990. This is the longest form and is, requires most detailed information, but most nonprofits, come under the easy form or the 990N form, so they don't have to worry. Form 990 PF should be completed by all private foundations. So I'm guessing none of you guys here are from private foundations. But regardless of how much money that you make or how much that you have in your asset base, that's something that you need to file for your file 990. If there are any questions with this, I will definitely take them separately with you guys because we're running a little behind time. And I'm going to move on to the next one that was asked: funds under the foundation and tax filing reporting requirements that you had. So I know I recognize a lot of faces, and I know Kathy there has questions. So there are about 6 or 7 types of funds. There's donor advised funds, there's scholarships funds, there's geographic area, designated agency, field of interest committee, special projects, and org agency funds. Now, donor advised funds are simple. Sakina Madraswala has a fund at the foundation. It's a donor advised fund. I can only give out grants to nonprofits. I cannot pay any bills or expenses. I can't run a whole program with it. It is a donor advised, one person or one family directed fund doing grants. The donor advised funds don't have anything to do with filing 990s. The foundation takes care of everything. Scholarship funds are again similar to donor advised funds. The only distinguishing feature is here the grant can go out to the school or the college that's getting the amount for the student, or it can be sent to the student directly depending on what the donor decides to do. So here the money can go out to the grant, to the nonprofit or the school in this case, or to a single person who's getting the scholarship. Again, scholarship funds don't have to do any 990 filing. The foundation does that. These are funds under the foundation, so they're covered. Geographic area funds are funds that are very similar to committee funds, but the only distinguishing feature there is they only cover a certain geographic area. For instance, we have a South Lake Tahoe fund that only gives out to nonprofits in the South Lake Tahoe area. There's normally a committee there, so that's why I said there's normally, they're very similar to committee funds. They can pay out expenses. So if they have like a meeting for their committee and they have like a meal that they decide to do, let's order in something, they can pay out expenses too. So they can pay out expenses A committee fund can also pay out expenses, and they can pay out, they can be reimbursed, etc. A designated agency fund, and again, geographic area funds don't have anything 990 to file. We take care of them. Designated agency funds are agency funds. I won't name a few, but I know a few. Or I can say, like, for instance, we have an ACRI family fund who gives out to CASA only. So they're available to spend. They have an endowment. They have a certain percentage, like 4% of their endowment. Remember, I spoke about restricted. They don't get the principal, but they only get the interest portion. Interest portion goes out to them directly. So that's designated agency. They only give out to that agency, and it's specified in like in the fund language that we have with the fund agreements that they have. Field of interest fund is like a specific fund that we have as a field of interest. For instance, I'm going to name one, which is fostering success and significance. We pay out expenses for them. We run their whole category, etc. And yes, funds can fall under more than one category. We try at the foundation to best pair them up with the category that we think that they fall under. Like, for instance, geographic area versus committee. They're very similar, but certain restrictions are there for geographic area, which committee funds don't have. The field of interest funds, they run a whole, like fostering success, they run a whole program. We pay all their expenses, we pay everything out, we do their 990 filing, we do everything, but they have admin fees which are greater than all the other funds there, just because they are more labor intensive to the foundation. Then we have committee funds, which obviously, you know, like we have, for instance, Women's Fund El Dorado. I know a lot of members are there at the Women's Fund. There are 400 members that come together, that pool in their money, and that's, you know, the committee decides on where the money should go. Again, they're labor intensive, so they have more, you know, they have more admin fees associated with them. But most of the committee funds are active committees. They're volunteer driven. They kind of have one or more, sometimes a contractor already working under them who manages everything. So easy peasy. Or special project funds are special projects that we take up, like CHP. You know, we do the Cops and Rodders event for them. It's, you know, they only need us from the months of September, or, you know, maybe July for their planning to July to October, and then they're done with their event. They've dispersed their money, and that's it. So they're kind of special projects. They have different fees depending on how much work is involved. The last one is the org agency fund, and this is the fund where I know we've had questions come in for. So if you are your own 501c3, and I know, I think Sue Hawks is somewhere in the list. I know she said that she was going to call in, but like Promise Foundation, they have their own 501c3. They are registered as an org agency under us. They file their own taxes. If you have your own tax ID, you have to file for your own taxes. That's the number one thing. And if you have your tax ID, then you will fall under org agency funds. There's nothing else that I can put you under IRS guidelines, because when somebody donates to the Promise Foundation, at the end of the year, our auditors take out that money from donations, because the Promise Foundation will put that donations under their tax ID, that these donations came under us. These donations did not come under the foundation. So our auditors actually back out all the donations that come for org agency funds, and org agency funds add up all the donations. We send them statements, so they add up all the donations that come under them. You know, so they're not double counted as such. There's only one org agency. I mean, all org. So that's the only thing. If you have your own tax ID, you've got to file your own taxes. You've got to do everything on your own. Otherwise, you would have to be, you would have to be under that org agency category, or we could do a special project for you. But again, that just means you would have to file your own taxes again, etc. So org agencies, I know that, for instance, New Morning has an endowment fund, etc. They all wait for their statements so they can show that this is their endowment at the foundation, and it's actually shown as an asset at their end. rather than showing as an asset under our end. So our auditors back out everything for org agencies. And my last question that I had is in-kind donations. And I know in-kind donations, I want to head back to the previous slide and say, if you are a fund under the foundation, other than an org agency, you don't have to worry about in-kind donations being listed on your statements, etc. We take care of those. I have a file in which I have all my in-kind donations for the year. If somebody gave, if you were throwing an event and if somebody gave a $25 basket that you gave away as a raffle in the raffle ticket, that's all documented, who got what, etc. So generally people give us an Excel sheet with a list, and they need, we need to send them out thank you letters or something. So we do that. But if you're an org agency fund, then all the stuff needs to be done at your end. And the second thing is, let me go back to the slide. It depends on what were donated at the time of fund. So if a donor comes up and says, I have this case of wine, and I'd like to give this case of wine, a women's fund has their events, and they say that a donor brings in a case of wine, it is fine, because each glass of wine is sold for $5 at Women's Fund El Dorado events. And this money is collected and again brought into, paying bills, etc. So if somebody's collecting money back, if it's a raffle ticket or if money is collected on these donations, if it is a donated item, it's fine. But if you are buying that case of wine, then you have to pay sales tax on it. So there are different laws on whether the item was donated versus whether the event manager or, if Women's Fund El Dorado bought their own wine and paid an expense out of their fund for it, then you kind of have to pay tax on the wine glasses that are sold. That's why we always say, that's why, all the events, basically we get donated wine, because so it just depends. So if there is a case and if you have questions on this, come and ask me. I definitely know what to do and what not to do now for fundraisers. And does time donated count as in-kind donations? I want to say no. So if I'm a CPA and I'm volunteering in my daughter's school to read, do their reading program, that would not count for the school as an, I won't get a tax acknowledgement letter for my time donated to the school, because one, it has nothing to do with my profession. But if I volunteer for XYZ nonprofit, my time and my effort to do their books as a bookkeeper, then yes, I will get a tax acknowledgement. I should, if I ask for one, get a tax acknowledgement letter from them saying that this was your time donated. The general fair, wage of bookkeepers is this. Had we had to hire somebody to do this, this is what we would have had to pay you. So it depends on the profession that you are in, whether, it is considered time donated or not. So always, I have more IRS material and guidelines that I could send you later, but always check if you have questions on these, whether, what counts as volunteering time and what actually counts as getting a tax acknowledgement letter for the time donated. That, you can volunteer your time, but it's definitely not, you don't get a tax acknowledgement letter for the time donated. I do have a question come in, so let me just hold on. I'm trying to see how I can do this with.
That's okay. Sakina, one that came in, actually, I'll go ahead and hit it real quick, but we got to make sure we wrap you so we can get to our stuff and we can take through all the others and answer them via the package that comes out. One of them was when it comes to raffles, if you are a fund underneath the foundation and do raffles, do we do all the filing and everybody's covered for the year, or does each individual fund need to file?
No, each individual fund does not need to file, as far as you send in an Excel sheet saying these were your donations. we take care of them. We have we have auditors who come and audit us, and I have to show that these were in kind. They necessarily don't show up on your financials. So I don't record in kind donations.
No, not in kind, raffles. So if an organization is doing a raffle, do you do the filings and the reports that are required by the state?
We actually don't. So you would not have to do, if it depends on the size that you're raffling for. If it's a small amount, I know that we don't need to do that. There are different guidelines for what exactly you're raffling. If it is a donated item, you don't need to file anything. But if it is something that's not donated but bought.
No. I'm talking raffle revenue.
I am not sure. Can I get back to you on it? Because
you betcha.
Yeah, because I know that I personally have not filed. I don't know if anybody else at the foundation does it or not. Okay. I kind of don't do that myself.
No worries. Why don't we, Sakina, we'll have the list. Let's grab the rest of them and let's take them offline. A lot of them are specific to funds. Kathy Lishman's had a lot of really great ones. And I promised this group that I would do a fund only. We need to do a fund only follow-up.
Okay, sounds good. And I have my last poll question for you guys. Just be honest. I don't see who is, I don't see who's marking off what. I just see percentages. So be honest and mark off what you think you've learned. And this just helps the foundation prepare for future, presentations. I know what you guys know, so I move on to the more, I move on to different material.
It's kind of starting to look like, Sakina, you just have a lot of different presentations to do, since a quarter of everybody knows from nothing to everything.
Poll, and I'm going to share results. So I'm glad some of them, are new to the nonprofit world. Welcome, and I'm glad this helped you out. So even if it helps out, like I want to say 10% of the, the people on this, I am happy to do this, and it is a learning experience. I learn something new every day. So I'm glad that a lot of people knew most of the material, but did find new information on it too. And I think it's a millennial thing to have memes on. So I'll keep having the memes on. So I'm going to stop sharing, and I'm going to send this your way, Kathy and Avis. I think
awesome.
Have this. Thank you guys. Thank you for listening to me. I know I talk a lot sometimes, but thank you.
It's all good, Sakina. All good stuff. I know a lot of people's brains are really swimming right now, so we totally get it. Actually, I'm going to see, let's see, I'm going to see if Chris, are you online? I know he actually sent me an email or a text saying he might be popping in and out. Let's see if he answers me.
I can unscreen. Sakina, can you stop your screen sharing?
There we go.
And I have control, Avis, if need be.
Okay. I am flipping. He may have stepped away, you guys. So I'll just go ahead and do Chris's. We do have, he's in at the office today, and I think somebody came to the door. So just so you know, so what's going to happen next week is where you guys have been registering for the classes on our website. Chris is revamping that whole thing next week, and it will include all the videos will be there. Right now it's there, but it's a little link. So you will see that whole page look fresh and new next week. With all of these resources there and available to get to them starting next week. So Chris will do that. And again, as usual, he will send out the package on Monday. And it may be a little later in the day because we definitely want to hit those questions that we didn't get to. So we'll need to pull those out of the chat and deal with those. So I'll toss to Kathy quickly so Kathy can share with you as far as the grant, the capacity grant, the timeline, and those sneak peeks that you guys get.
All right, so here is my little visual for you all for what comes next. If you are interested in the grant that we're going to be putting out here in April, the top part is a visual and the bottom is just a list, because I know there's different type of learners out there. But anyway, April 14th, the capacity building grant is going to open on our website. We will send an email out with the link to all the nonprofits who are on our mailing list. Who are on the mailing list who have attended these 5 classes is what I mean. And the grant timeline will close, or the grant cycle will close on May 19th. So you have a little over a month to complete the whole thing. And then we are going to take a little over a month to review all the applications. And then last week of June, grant recipients will be announced. Grant acknowledgement forms will go out. Once again, please read them very carefully so you know what you're agreeing to. And around July 1st, we will be dispersing funds to the recipients. From there, if you look at the circle, the grant cycle begins July 1st and the funds must be spent in a year. And then between October and January, you will hear from Avis and myself for planning a site visit so we can see how it's going for you and you can ask questions of us. Between March and May, we'll be doing exit interviews and summaries. Actually, Avis will be doing exit interviews and summaries. And then in June, final reports will be due. Technically, final reports aren't due until July 1 of that next year, 2023, but we'll be asking for them in June, especially for those of you who are grant recipients who are looking for a second year of funding. So in the end of June, announcements will be made to those first year grant recipients if their second year will be funded, and that will really depend on how accomplished it shows that the first amounts of money were spent. That's basically the timeline. I'm trying to go quick because I know we're running out of time. Down here at the bottom is the timeline just listed if you don't like my picture. And then we'll make sure this gets out to everyone as well. In case I went too fast. And then I wanted to share.
People writing feverishly.
Oh, don't have to write. It'll all come to you. And remember, when we send the presentation, we'll make sure you have it, okay? And then the sneak peek, which many of you probably already saw because I put the email out yesterday, is this. Plan on this in every application going forward to, plan on this with every application going forward, but we will be asking for these 3 screenshots. Ultimately, it shows that you're in good standing with the state of California. Again, if you're, or I shouldn't say again, but if you're not in California, we will also share how you can do this from whatever home state you are registered in, but you will need to click on the IRS database and take a screenshot of your organization and show that your IRS filings are current. Some of you will show 2020 and maybe 2019 as well, but also some of you might show 2021 already if you started in January. Then you're going to visit the Secretary of State website and search for your organization and take a screenshot that shows that you're active and up to date. That is something that needs to be done every 2 years for every organization. And lastly, the Department of Justice website. The Attorney General requires a charitable trust paperwork for every nonprofit every year. It's just a 1-page document. I'm sure most of you are up to date because they usually send a bright yellow or green paper every year to make sure that you've done your charitable trust paperwork. But we want a screenshot that shows your organization name and that your stuff with them is current. And you'll be putting that into this file. This will be for all grant applications, including the capacity building grant. And the reason we're sending it out early is if some of these words are like, wow, I've never heard of that, we're giving you a couple months to get everything in order to make sure you can figure it out. And yes, of course, you can email me. I don't know if every one of you is on our email list, but if you are, you received this yesterday, this email, and below the picture that I just showed you right here that I'm scrolling over, down here, these links actually open up because this was an image, so you couldn't, to help you get started if you need help, okay? These are the 3 images, links for the IRS, for the Secretary of State, and for the Department of Justice. If you are not in California, if you click on here and then type the name of the state that you're a part of, and after, so for example, Nevada is probably the big one, right? Nevada, and then nonprofit compliance, it will share with you what you need to do and what is the same thing or comparable as the statement of information and registry verification. Okay, that's in a nutshell. Avis, I'm going to stop sharing and let you finish.
Okay.
Whew, that was fast.
And don't worry, if you've never done this screenshot before, whenever this goes live, there is actually a tutorial video that Chris Ringness did teaching you guys how to do a screenshot and how to upload it. So, and it has it for like any type of device you're on. So it's awesome. So that is that. And yes, if you are underneath a larger entity, you would submit that larger entity's EIN information in there because you'll be putting in their EIN. Go, Kathy.
Avis, real quick, just so you guys aren't expecting a tutorial. It's not a tutorial by Chris. He did find the website. The website to help you with a screenshot is amazing because it tells you how to take a screenshot from any apparatus you can picture. So you'll just have to scroll down and find your apparatus. Sorry about that.
And with that, you guys, it's pretty much 2 months almost from this coming Monday. So that's why we wanted to finish these classes in advance, because again, these are capacity. So it is, you know, here's your chance for that bookkeeper. Here's that chance for that role that you need. These are, Kathy, the question was amounts, $50,000, right? Is the upper limit of these and stuff. So $50,000 to a single organization. Kathy and I really pushed Bill on that one because we felt 50K was good to hire someone, you know, part-time or somebody on a lower level to get a job done. So these are capacity. You have 2 months now to go back, talk to your board, see what makes sense. This is not a program grant. This is a capacity grant, so very different. So super have fun. 25K to 50K, Kathy just put into the chat on this. I'm gonna share real quick because I think it's gonna be especially valuable after today. What comes next as well is, come on, because you guys have had so many amazing questions, we're going to implement monthly office hours. So every month on the third Wednesday from 11 to 12, Kathy and I are going to go online on Zoom, and we're going to be available for you guys to drop in, just like a professor and stuff. Even though we're not quite professors, we're going to give it our best. So it's going to be open to any nonprofit staff or volunteer to drop in with questions, help needed, resource directions. She and I'll just be sitting there, and if it's just us alone for an hour, we'll have work to do and stuff. So we will send out a reminder, a Zoom link every single month, about 1 to 2 days prior. It's going to be a static Zoom link. So if you want to go ahead once you get that first Zoom link and throw it on your calendar and stuff and have it there every third Wednesday from 11 to 12. We tried to butt it up against lunch for those of you that are really busy. But if you have something, it's a good way just to drop in and we will be there. So Kathy and I'll be online for that hour to answer any questions, and it will start next week. So especially this financial stuff that was really a lot. If you have follow-up questions next week that you don't get answered in that package, we'll be there next Wednesday from 11 to 12 on that Zoom link, and you guys will get it. You guys, we're going to get it out to you first, and then we will also on our resource page put a way you can subscribe and get the link as well in the future. And then the last little tidbit for today is those master classes. I think we're all kind of swimming. We even are at the foundation. But in the future, and I'm not going to commit to exactly when now, we will be offering master classes in the area of governance, donor development, communications, and cost accounting. So those will dig deeper. They probably will not be given by us. We will probably partner and co-present these with other entities. Probably the Impact Foundry out of Sacramento is one that's willing, has said they want to play in this space with us. So these will be offered in the future. We kind of have to do some planning internally to see if it's something we will do late this year or the beginning of next year. But we will get to those master classes. So those will be out there in the future. So I will stop share now so I can see everybody's faces. 5 weeks. It's been amazing, you guys. Thank you so much for supporting us and do this. We were able to do this whenever you were here. We couldn't do it without you. Again, the whole goal of this was by you guys being better at what you do, it makes our whole community better because you guys are really so much of what's behind it. And we really are. I mean, just this week at our staff, it really was just, it's kind of bittersweet. It's been an amazing journey over these 5 weeks. It's something I don't think the foundation saw a couple of years ago, but as we've grown and as our nonprofits have grown in the county, something that we've definitely seen that was needed and of value. So again, we'll be out there next Wednesday on Zoom. If you need Kathy and I, we're always available via email. The package will be out on Monday, and I think that's it. Thank you guys so much for the last 5 weeks, and share that as well with your other attendees. And bye. It's sad. Bye, everybody. See you soon.